you can all see why we began the conversation for this conference around the particular narrative of Linus and Amanda in particular. Thank you. That was a powerhouse speech. It helped kind of crystallize many of the issues we were discussing. And it also is a perfect segue into this last panel between us and lunch. And that is really where the rubber meets the road, money. Because you can talk about societal good, you can talk about supply chains, you can talk about national security aims, but ultimately, these are commercial ventures. And unless there's financing for them, they remain in the conceptual range, not in practice. And so we're very fortunate to have today with us Grant Nichols, who's the Director for Natural Resources WA for ANZ Bank, and also from Singapore, Chong Foong, who's the Vice President and Director of Equity Capital Markets, Global Sales and Origination at the Singapore Stock Exchange. And so it's wonderful to have you both here think through some of the issues we're challenging. And so I just wanted to take just for a second the Linus example and set it aside and recognize that there are a lot of other ideas. There's a lot of other potential projects out there. And yet they all face a shared challenge, which is how do you articulate, a funding case for a project that is not as well established or well understood as base commodities? Because this town, as probably is demonstrated very well, understands commodities extremely well. The governor introduced Western Australia as the world's leading natural resources province. And yet, if you're like me, if you've learned anything during the course of just this morning alone, it's how complex the critical materials markets is. And so I was wondering if I might just start with you, Foong, and just kind of have you start off thinking about what are the things that we need to understand about this particular sector from your perspective, and then I'll go into some other questions after you at that, Grant.
Yes, thank you, Professor Gordon, and thank you for inviting me here for this In the Zone event. I'm honored to present. So as you mentioned, I work in the Singapore Exchange, and I'm in the Equity Capital Markets department. So my role is to attract companies to list on the SGX. In that role, I also work with capital markets professionals and also with investors. So I try to create an ecosystem. The journey of minerals, or what we call mineral oil and gas, or MOG, on SGX started about 9 years ago when we introduced special listing rules. So maybe this is one of the first areas I'll talk about. And we actually grew from 3 minerals companies listings to today 17 minerals companies listings. And one of the interesting statistics I'd like to share is that for the last 3 years, 2017, 2018, and then also 2019, on the SGX's Catalyst board, which is our fast growth board, the top traded sector by dollar value was actually mineral oil and gas. And in the year 2017, the top traded company by dollar value was a pre-production Western Aussie hard rock miner. So just as critical minerals, they're unique, and I'm sure we'll get into it in a bit more detail. There also exist other solutions, or maybe not so obvious solutions, that are in the zone, which could benefit critical minerals players. And Singapore capital markets could be one of those avenues.
Thank you. Grant?
So firstly, thank you, Gordon, and thank you, Jeff, for inviting a banker to come and speak at your conference. I told my wife, she said, you're either very brave or very stupid. I thought it was brave, and I'm thinking the latter.
My wife has no ambiguity about that question.
Good. I think within ANZ, we've obviously been banking resources for multiple decades. And our core strengths have always been on the bulks, the iron ores, the oil and gas, the gold, the obvious ones. Within our portfolio, we have been focusing on, so specifically in my portfolio, battery minerals. So for the last 18 months, I've been driving some of the strategy within ANZ in terms of how we focus on that as a company. We have separate portfolios that look at sustainable and renewable financing solutions, and then again, alternative fuels, like hydrogen, etc. To answer your initial question, I think in some ways there's a lot of similarities to the way you have to look at these projects, and I'll explain that now. And then in other ways, there's a lot of unique aspects. I think it's no secret that in some cases, like rare earths, there's over 30 different processes as you move from upstream all the way through to downstream, especially in the midstream processes. So because of that, there's a lot of intricacies, there's a lot of complexity. that needs to be understood. So there's a technology risk that in some cases is new and does not exist in the iron ore industry, for example, or the nickel sulfide industry, because it's been around for that long. I think the other issues that you'd look at is clearly in the case of critical minerals, there's not a lot of liquidity in that market, and therefore there's a lot of volatility in price. So with that volatility in price, I think sometimes there's a bit of a misconcept. People say, well, how can we bank this because the price is all over the show? We typically look at this in the same way we look at almost any other resource project and ask ourselves, what's the fundamentals? How does the project stack up on the cost curve? What's the all-in sustaining costs? How much do we actually understand that that's the capital costs with regards to do you go big and do a big development up front in order to reduce the OPEX thereafter, or do you actually stagger it in a modular approach? Those are questions that's not dissimilar to any other commodity. I think what makes critical minerals more unique is probably because you have a whole bunch of stuff that make it a bit more volatile in terms of the price. I think we're seeing in the case of batteries and lithium, for example, there's a lot more emphasis on quality. In iron ore, if you get the constituency wrong of the ore quality, you may pay a penalty. At worst case, you get rejected for that particular shipment. We can see in the case of Apple, Samsung's, and when they have had different challenges in the MacBook, etc., for Apple, when the battery explodes, or there's a potential risk of the battery explode, the reputational damage of that is phenomenal. So understanding where the source of that quality and the issues lie, and it goes all the way through, potentially through to the source and the mining, is pivotal. And I think there's going to be a lot more focus on that. That affects then the understanding of the funding, because with that funding comes the ability to develop the right chain, the value chain, from supply to the midstream to the downstream. So I think there's a lot more intricacies and a lot more complexity.
So I'd like to ask you both about the question of scale. You talked about ANZ's own experience having been focused much more on the bulk side of things. It seems to me, kind of what I heard you saying, that is there does seem to be the same level of complexity and the same level of risk involved in one of the many nascent rare earths projects in particular, but also other critical materials. So the same level of risk, and yet the scale is relatively small, and so you're again taking on more risk for much smaller potential of return. Is that the question of scale? Is that a factor? Are the rare earth projects just small enough that they're hard to justify the risk, or is that a misreading of the situation?
I think that's a very interesting insight. So once you look at a smaller scale, you're no longer in the realm of large institutional funding, for example. And now you may be looking at maybe not $1 billion of fundraise, it may be 100 or 10 or even less than that. So what kind of investors will you actually start looking for? And particularly if it's what we're talking about, a smaller scale critical minerals project, the types of investors may include family offices, ultra high net worth individuals, or similar investors that are able to take longer term views on projects and are patient enough to actually understand and study what the real risks are in that particular type of project. So if I can again talk about the Singapore capital markets, there's $3 trillion in assets under management. One of the unique things is that 80% of it comes from outside of Singapore. So half of it comes from within Asia-Pacific and the balance between Europe and North America. It's this interesting environment where you're going to get a variety of investors that have very different backgrounds. They're able to look at these trends at a very long-term, sophisticated way. And their investment quantum may actually match something that a critical minerals project, depending on the scale, may be looking for.
Grant?
So if I can quote Dr. Jeff Wilson, I'm sure he's here somewhere, and if I can quote his research, some of the numbers he showed in the 2017 research was the combined value of all 30 categories of that critical materials is something like 75 billion US. If you look at iron ore sector alone, it's about 90 billion. And then natural gas would be, I think he said 173 billion, and oil alone would be $448 billion. So to put that in scale, I guess, yes, at this point in time, it's not a huge sector by itself compared to some of the other sectors. And so from an economic perspective, it doesn't have that sort of scale compared to some of the big bulks. However, clearly it's becoming much more important on the scale of things looking forward in terms of the importance and how it gets incorporated into the future from an EV perspective, for example. I think the importance of scale here, especially on some of the bigger names, the corporate names, is one of confidence. It's one of, when you're dealing with some of the bigger names, and it comes back to your initial question, Gordon, was how is it different? I think the difference and the scalability are sort of interlinked. You've got to look at this in terms of saying, for example, if you look at lithium, you go from the mining through to the concentration, through to the lithium hydroxide refining, through to the battery manufacturing, and then through to the car manufacturers, right? It's across that value chain. And I think that value chain, what it does do, if we as a bank were to fund that, we would look at that and say, well, where's the confidence, where's the value in the offtake contracts, for example, to validate that there's a demand for it, and that the name of the players, whether it's a Tesla or a CATL or the bigger the name in terms of the offtake contract, to be quite frank, the more confidence you have in the ability that would be sustainable, in the sense that even when prices fall, they would honor those contracts, both from a volume perspective and from a price volatility. That's one of the biggest concerns at the moment in the market, that with all this volatility, you may find that there could be an inclination for some of the offtakes to actually, I guess, not renege, but potentially reduce their demand at a point in time that then has a consequential knock-on effect all the way back into the actual borrower, who's the miner who we potentially funding.
So let me ask you about the international element of this. As you've heard me say repeatedly during the course of the morning, one of the underlying premises behind In the Zone as a conference, regardless of the issue that we're working on, is that individual countries can't solve this problem by themselves. And we've seen some very specific examples of international cooperation in the case of Linus. Of the countries that we've had speak already today, we've got the full spectrum, right? You've got the case of China, which has been complimented for basically dominating, the full chain in that process. And yet you've got countries like Australia that tends to be more purist in terms of market interventions. The United States, where it's willing to, as long as it's couched as national security. Others that are more proactive, with the leadership of JBIC and others. I'm curious as to how you see the international cooperative element of this, given the different natures of governments and different approaches to industry. In this sector in particular, is there a unique requirement for international cooperation because of that?
Well, some of it is kind of market forces that was discussed earlier. You may have read earlier this year, Dyson relocated its headquarters to Singapore, and as part of that move, they decided to open their EV manufacturing site in Singapore. So this is something which has happened for Dyson's own reasons, but what that means for the players in the zone is that there's going to be another EV player that's located in a neutral hub country, and which is, I believe, the closest Commonwealth city to Perth. So that creates opportunities. It's up to the market players to try and reach out to connect all the dots between the mine mafia to the actual EV manufacturer.
As somebody who owns a Dyson, I can't resist the connection between a vacuum manufacturer and EVs because, that joke kind of writes itself, but we won't go there.
Driving a vacuum cleaner.
Yes, Grant.
Yeah, look, I think that this particular sector lends itself even more to a joint approach, and I think the irony is that Australia has got all the raw materials and all the capacity, combined with potentially all the renewable links to power that in terms of solar, wind, and ground, as we heard earlier today. I think that, yes, what what China has done very successfully is to incentivize some of their key manufacturers and players to do that, and to create that lead time for them to get up and running. And I think, to be quite frank, I think private financial corporate combined with government needs to work together in order to create a solution. That solution, part of that solution is the funding. But until you actually have those aspects, I think what will happen is you will look at each project independently and individually, and therein lies potentially some of the increased risk, because there's a whole array, there's a spectrum of projects. Some of them will fall over, and some of them have already fallen over in this particular sector. And then there'll be successful ones like Linus, etc., that have forged forwards and have created, and as Amanda said, I mean, it hasn't been all smooth running. They've had their ups and downs, and they had their support through that process, which is awesome. But you need, in banking, you've got to bank the winners. But the question is, who's the winners here, and how do you identify them? And how do you identify them as an industry? And how do you get the various participants, including government and sector, to jointly come up with a structured solution? And I think it has to happen. I think if you don't do it, you will look at it independently on a project by project basis, and some of them just won't stack up. They will fall over.
We're already eating into our lunchtime, but I have one final, just kind of brief question, again, that kind of goes to the crux of what we've been discussing thus far. And given the fact that we've got policymakers from so many countries here in the room, and such a good delegation come over from Canberra, I'd like you to address the role of government, in particular both WA and Australia more broadly, given the fact that there is a sense of kind of ideological purity about markets. This conference was set up kind of on the presumption that the strategies on a policy level for critical materials more broadly, and rare earths in particular, had to be different than the strategies for core commodities. If that's true, and I welcome your reaction to that, is there a different role for government in this sector than there would be in other commodities?
I can only think of the typical listing and fundraising process for equity, where one of the major roles of the government would be through the licensing process. So perhaps one of the ways that the Western Australian or the various state governments for the rare earth projects that they believe is worthy, if there was a way to create a very visible accelerated lane for the various environmental approvals, so that it's much easier for investors and including those from other countries to understand that this particular project has been earmarked and that it's been prioritized. If not this, even though Australia is a mining country, from an outsider's point of view, maybe the application is just lost in the woods, so to speak. Yeah.
Grant, final words?
I think it's a great and difficult question, to be honest, but I think that in this particular sector, I think there's a couple of areas to cover. The one would be, and this is feedback from some of my clients that I speak to, just the speed and the time in terms of environmental approvals, permitting, etc. Again, that needs to move faster. There's a lot of frustration there still that some of it needs to be expedited. I think in terms of an overall funding solution, I think you'll find that the commercial banks would be very happy to work with the likes of NAIF and EFIC, EFA, and other exchange credit agencies to come up with a joint solution. I think government needs to be part of that solution. I think there may even be and need to be, I believe, a medium to longer term strategy where government may have to incentivize companies in the sense that, not just on the exploration budgets, but more in terms of saying it could be a staggered approach in terms of royalties, could be in terms of some form of incentivization or subsidies that they need to put in place for the sector. And I'm not saying necessarily that's just across the mining. If we want to develop refinement capacity within WA or within Australia, it means that we have to take a consolidated view. And I think government playing together with banks and financial institutions, together with corporates and the end users, The battery manufacturers combined with some of the auto manufacturers we see are coming into the sector and talking to us about endorsing some of these things. I think looking at it jointly is the right approach to come up with a joint funding solution.
Oh, fantastic. We could go on this subject, but you've all been extremely patient this morning. We're now at the time for our lunch break, which will be immediately outside where we had the reception. Feel free to bring the food back inside if you would like a place to sit down. But I think you'll agree with me. This morning, we've already had a very full morning. I hope you'll take now close to an hour to interact. One of the challenges of having a packed schedule is we don't have the interaction with the audience, but Amanda and others have been very kind to offer themselves up for conversation during these breaks. I hope you will all join me, one, in thanking this panel and the full morning, and then enjoy the lunch break, which is sponsored by the City of Kwinana, and we'll have a short promotional video play us out as we go in there. So please, thank you for the panel. Thanks.